What is going on, guys? Nick here, back with another video. DraftKings reported earnings on February 18th and the investor reaction wasn't great. While DraftKings beat estimates, the stock fell 21% after DraftKings announced they expected a more enormous EBITDA loss for 2022. The sports betting market is massive, with some estimates as high as $180 billion by 2028. And right now, DraftKings, Penn, FanDuel, and most major casinos are fighting for market share as states legalize online betting. DraftKings' strategy has been to aggressively market themselves anywhere and everywhere they can. They want customers to think of DraftKings, especially the younger online audience, as the first place they look when thinking about betting. Their strategies included TV commercials and sponsorships during sporting events, to hiring influencers like Pat McAfee, John Boy, and the NBA. But this marketing strategy is extremely expensive, and I think there's been some pretty valid questions into how sustainable this business model is. So in February, when DraftKings announced their earnings, they reported a loss of 35 cents per share versus a loss of 81 cents per share expected. And revenue came in at $473 million versus $445 million expected. So DraftKings was able to beat on both top and bottom lines. The issue came when DraftKings said they expected an adjusted loss for 2022 between $825 million to $925 million. This is a much bigger loss than the anticipated $572 million that analysts had anticipated. When we look at the trailing 12 months of earnings reported by each quarter, with the most recent earnings reported in red, this most recent quarter seems like a positive improvement for now. Over the last year and a half, DraftKings has lost somewhere between 75 cents per share all the way up to $1.80 per share each quarter, so a 35-cent loss is a big improvement. When we look at the past 5 years worth of revenue and net income, we can see that while revenue is growing pretty quickly, their losses are actually growing even faster. They've actually lost more money than they made over the past 2 years, which to me isn't really something that I like to see. When we look at the revenue versus expenses to try to understand why they're losing so much money, we can see the cost of revenue isn't that bad in comparison to the revenue. Their sales and marketing budget, though, is absolutely massive. And this is on top of the already enormous general and administrative costs. The sales and marketing budget increase is pretty self-explanatory, but the general and administrative cost increase is due to them paying $267.5 million in stock-based compensation. They also said they had to hire more staff to deal with advocacy efforts and other legal costs in areas that they currently don't operate in, as they try to lobby to legalize sports betting in those areas. This chart basically shows their expenses so that you can see a change in where they're spending their money. These percentages are the percentage in relation to their revenue, and we can see that while sales and marketing in 2020 was 80% of the revenue, in 2021 that actually slightly dropped. We can also see that the cost of revenue did slightly increase and has been increasing since 2019. It's grown from just 31% of the revenue all the way up to 61%. DraftKings explains that part of this issue is due to certain states requiring DraftKings to have a relationship with a retail operator for their online sports books. DraftKings also explains that $270 million of their cost of revenue increase is due to product taxes and payment processing fees, as well as revenue sharing agreements with other companies. Now, DraftKings breaks their business down into two segments: business to consumer and business to business. We can see that business to consumer is pretty much their entire business, but neither of these generates a profit. When we look at DraftKings forecasted earnings, we can see that while revenue growth is projected to continue to rise, 2022 is expected to result in an even larger loss than we've previously seen. The current analyst estimates see a loss of about $2.9 billion, while they only anticipate DraftKings to bring in about $1.9 billion. Even going all the way out to 2024, we only see DraftKings bring in about $3.2 billion versus a loss of $1.2 billion. So DraftKings appears to be a pretty long way from becoming a profitable company. Looking at the revenue growth, we can see that DraftKings revenue, while they are still projected a huge loss by 2024, is also projected to slow down to just 26% by that year. If DraftKings is still projected to be that far away from profitability by 2024 and the revenue growth is starting to slow down, will DraftKings ever actually become profitable? Now, I think for this valuation, I'm going to have to look at it in two ways. First, since they aren't profitable yet, we'll have to use a price to sales valuation. I'm going to use a growth rate of 20 to 25% for them. The tricky part is figuring out the appropriate profit margins. I think a 10% profit margin is about what I could reasonably expect for this type of business to be able to achieve. However, if rising competition and high taxes, which are common in this industry, eat into the profit margins, I think a profit margin of about 5% is possible as the worst case scenario. Since DraftKings reaching profitability is a long way away, I think it's better to look at the different potential outcomes so we can understand all of the possibilities as things shake out. So using a 20 to 25% growth rate and a 10% profit margin gives us a price to sales ratio between 5.2 to 7.9. So when we look at this valuation charted out, it seems like DraftKings is currently very cheap, and I think this is because the market is pricing in a lot of potential risk that DraftKings never really becomes profitable. So if we cut the valuation in half and use a profit margin of just 5%, this adjusts our price to sales ratio down to 2.6 to 3.9. So looking at this more risk-adjusted valuation, we can see that DraftKings is currently projected slightly higher than this current valuation and wouldn't hit the bottom end of their fair value until after 2023. I would say that this valuation is a good estimate of their value because it seems like their profits are going completely in the wrong direction, even if the most recent quarter's earnings were better than expected. Now, this valuation is a pretty big drop from what I previously thought they were worth. And looking at my forecasted earnings from my previous video, we can see how much the 2022 projected losses have changed. It looks like during that video they were forecasted to lose around $300 million, and that number sits today at nearly $3 billion. Even if we look at 2021, analysts had only anticipated about a $500 million loss, and those numbers finalized at $1.5 billion, so about $1 billion over what was anticipated. So this is why we've seen DraftKings fall so much, in addition to the negative trend with a lot of growth in small cap stocks. The company is so aggressively trying to grow their revenue right now, they're driving some pretty steep losses, and I think this has investors a little spooked. I'm just not sure that DraftKings is an established enough name at this point where people would automatically go to use their product, so at this point I think they still need to aggressively market to grow, especially because I'm just not entirely sure that most people realize they're a sports book and not just a daily fantasy app. Now before you go, make sure you check out this great video I have over here for you next, and as always, thanks for watching.